Ladies and gentlemen, stop what you're doing right now. Put down your phone. Turn off the talking heads on CNBC, because what I am about to show you is not speculation. It is not fear-mongering. It is a mathematical certainty that is unfolding in real time across three of the most critical markets on planet Earth: oil, gold, and the US dollar. And the trigger, the spark that just lit the fuse, happened 72 hours ago in the Strait of Hormuz, when a US destroyer fired on an Iranian naval patrol boat. The price of oil moved, gold spiked, the dollar flinched. But that is not the story. The story is what happened in the 48 hours after the headlines faded. The story is where the money went, and more importantly, where it did not go. Asian guy here. I need you to understand something fundamental about how power works in the modern world. Power is not measured in aircraft carriers or nuclear warheads. Power is measured in the ability to move capital. And right now, we are watching the largest capital reallocation event since the 2008 financial crisis. This is not about who wins a military skirmish in the Persian Gulf. This is about who controls the flow of energy, who controls the pricing mechanism of commodities, and who gets to decide what money actually means when the shooting starts. The United States just made a move, and the rest of the world is responding. But the response is not what Washington expected. Let me show you the data. In the last 72 hours, Brent crude oil, the global benchmark, jumped from $81 per barrel to $89. That is a 9.8% move in 3 days. Normally, that kind of spike would trigger immediate selling. Hedge funds would short it. Algorithmic traders would fade the move. Central banks would release strategic reserves to calm the market. But none of that happened. Instead, the volume increased. The open interest in oil futures expanded, and the backwardation in the forward curve deepened. Translation? The big money is not selling the spike. The big money is buying into it. They are positioning for $100 oil, and they are doing it quietly, systematically, without waiting for confirmation from the news cycle. Now look at gold. Gold moved from $2,187 to $2,161 in the same 72-hour window. But here's where it gets interesting. Normally, when oil spikes, gold follows because both are inflation hedges. But the ratio between the two tells you what kind of crisis the market is pricing in. If oil rises faster than gold, the market is pricing in a supply shock, a temporary disruption. If gold rises faster than oil, the market is pricing in a currency crisis, a loss of confidence in the reserve system itself. Right now, gold is outpacing oil. The gold-to-oil ratio just hit 33.2, the highest level since March 2023. The smart money is not just hedging inflation, they are hedging the dollar. And that brings us to the third leg of this triangle, the US dollar. The DXY index, which measures the dollar against a basket of major currencies, dropped from 108.4 to 106.1. On the surface, that looks like a normal risk-off move. Investors selling dollars to buy safe havens. But dig deeper. Look at the specific currency pairs. The euro gained 1.4% against the dollar. The yen gained 2.1%. But the Chinese yuan, which is supposed to be pegged and controlled by the People's Bank of China, gained 2.8%. That is not a market move. That is a policy move. Beijing is allowing the yuan to strengthen against the dollar at the exact moment when Washington needs a strong dollar to finance its Middle East operations. This is economic warfare disguised as a floating exchange rate. And it gets worse. The offshore yuan is trading at a premium to the onshore yuan. That means massive demand for yuan outside of China from oil buyers and commodity traders. The PBOC is letting it run because every basis point the yuan gains makes Chinese oil contracts more attractive and the dollar less essential. Connect the dots. The US just escalated tensions with Iran. Iran controls the Strait of Hormuz, through which 21% of global oil supply flows. If Iran closes that strait, oil does not go to $100. It goes to $150, maybe $200. The global economy seizes, inflation explodes, and the Federal Reserve, which is already trapped between fighting inflation and preventing a recession, faces an impossible choice: raise rates and destroy the economy, or print money and destroy the currency. But here is the trap. The trap that most analysts are missing. The United States cannot afford $150 oil, not because of inflation, not because of consumer pain at the pump, but because of the petrodollar system. Let me explain how this works. Since 1974, oil has been priced in dollars. Saudi Arabia, OPEC, everyone sells oil in dollars. This creates automatic demand for the dollar. Countries need dollars to buy oil, so they hold dollar reserves, they buy US Treasury bonds, and they finance the US deficit. This is the foundation of American financial hegemony. But the system only works if oil flows freely. If the Strait of Hormuz closes, if Saudi oil cannot reach Asian buyers, then the Asians have no reason to hold dollars. They can settle oil in yuan, in rupees, in gold, and whatever works. The petrodollar does not die from hyperinflation. It dies from irrelevance. Think about the mechanics. Every day, the world consumes roughly 100 million barrels of oil. At $90 per barrel, that is $9 billion in daily transactions. Multiply by 365 days, and you get $3.3 trillion in annual oil trade. If even 30% shifts away from dollar settlement, that is $1 trillion in reduced dollar demand per year. Add natural gas, coal, iron ore, all the commodities starting to trade in alternative currencies. You're looking at multi-trillion-dollar reduction in structural dollar demand. That is not a currency crisis. That is a currency extinction event. And this is exactly what is happening right now. While you were watching footage of missile strikes and aircraft carriers, the Saudis were in Beijing negotiating the expansion of yuan-denominated oil contracts. The Indians activated a ruble mechanism to buy Russian oil without touching the dollar. The Iranians are selling oil to China in yuan and converting it directly to gold on the Shanghai Gold Exchange. These are not hypothetical scenarios. These are executed trades, verified flows. The world is building a financial system that routes around the dollar, and they are doing it in broad daylight while Washington is distracted by the military spectacle. Now, let me show you where the money is actually going. This is the part that should terrify every pension fund manager and sovereign wealth fund in the West. In the past 72 hours, we have seen $43 billion in capital flow out of U.S. equity markets. The S&P 500 dropped 3.2%. The Nasdaq fell 4.1%. Normally, when stocks sell off, the money goes into treasury bonds, flight to safety. But this time, the 10-year treasury yield rose from 4.52% to 4.61%. That means bond prices fell. Money is leaving stocks and bonds at the same time. So where is it going? Into commodities, into gold, into oil, into industrial metals. The Bloomberg Commodity Index gained 6.8% in 72 hours. That is the biggest three-day move since the Russian invasion of Ukraine. But there is a second flow that is even more revealing. The flow into physical assets, not paper contracts. The Shanghai Gold Exchange reported a 340% increase in withdrawal requests. That means buyers are not just going long gold futures. They are taking delivery. They are pulling the metal out of the vaults and moving it into private storage. The same thing is happening in oil. Tanker rates from the Persian Gulf to China just doubled. Chinese state-owned oil companies are filling every available storage tank, every floating vessel, every strategic reserve they can access. They are stockpiling physical oil at $89 a barrel because they know what is coming. They know that if this conflict escalates, if the U.S. imposes sanctions on Iranian oil exports, if the strait closes even partially, the paper price will be meaningless. The only thing that will matter is who has the physical barrels. And this brings us to the real question, the question that nobody in Washington wants to ask out loud. What happens if the U.S. loses control of the oil market? What happens if the price of oil is no longer set in New York and London, but in Beijing and Mumbai? What happens if gold, not the dollar, becomes the ultimate settlement asset for energy trades? The answer is simple. The U.S. Treasury market collapses. Not slowly, not gradually, but in a violent repricing event that makes 2008 look like a dress rehearsal. Because if foreigners do not need dollars to buy oil, they do not need to own treasury bonds. And if they do not need to own treasury bonds, who is going to finance the $2 trillion annual deficit? Look at the numbers. Foreign holders currently own $8.1 trillion in U.S. Treasury securities. If those holders reduce their positions by just 20% over 2 years, that is $1.6 trillion in selling pressure. The Fed would have to absorb that. They would have to print just to prevent yields from spiking into double digits. And if the deficit grows to $3 trillion because of recession or war spending, you're looking at $4 to $5 trillion in Treasury issuance with no natural buyer. That is when the printing press goes into overdrive. The Fed. That is who? The Fed will have to print, they will have to monetize the debt, they will have to become the buyer of last resort for their own government's bonds. And the moment they do that, the moment the market realizes that the Fed is printing not to stimulate growth, but to prevent a sovereign debt crisis, confidence evaporates. The dollar does not gradually weaken, it gaps down. And when the dollar gaps down, the price of everything priced in dollars, oil, gold, commodities, food, gaps up. This is the hyperinflationary endgame that the Austrian economists have been warning about for decades. And it does not start with the Fed announcing QE infinity. It starts with a geopolitical miscalculation in the Strait of Hormuz. Now, I know what some of you are thinking. You are thinking, Asian guy, this is too dramatic. The U.S. has been in Middle East conflicts for 30 years. We always figure it out. The dollar always survives. And you are right. The dollar has survived Vietnam, Iraq, Afghanistan, Syria. But there is a difference this time. This time, there is an alternative. In the 1970s, when oil prices spiked, there was no alternative to the dollar. The euro did not exist. The yuan was not convertible. Gold was illegal to own in many countries. Investors had no choice but to recycle their oil profits back into dollars and treasury bonds. But today, China has the yuan. They have the Belt and Road Initiative. They have gold-backed contracts on the Shanghai exchange. Russia has its own payment systems. India has UPI. The infrastructure for a post-dollar world already exists. It is not theoretical. It is operational. And every time the US weaponizes the dollar, every time Washington freezes Russian reserves or sanctions Iranian banks, they accelerate the migration away from the system they built. Let me give you a concrete example of how fast this is moving. 3 months ago, the United Arab Emirates, one of the closest US allies in the Gulf, announced that they would accept yuan for oil sales to China. 2 months ago, Saudi Arabia renewed a currency swap line with China worth $7 billion. 1 month ago, the Shanghai Petroleum and Natural Gas Exchange launched a yuan-denominated futures contract for Middle Eastern crude. And now, 72 hours after a US military strike on Iran, we see a massive surge in trading volume on that exact contract. The pieces are not being put in place. The pieces are already on the board. The game is live. So what is the trade? What is the actual actionable intelligence here? The trade is simple. The world is moving from financial assets to real assets, from paper to physical, from debt instruments to tangible goods. If you're holding long-term treasury bonds yielding 4.5%, you are holding a depreciating claim on a currency that is losing its monopoly. If you are holding cash in a money market fund, you are holding a wasting asset in a system that is being bypassed. The smart money, the sovereign wealth funds, the family offices, the central banks that understand what is happening, they are moving into gold, into oil, into farmland, into water rights, into anything that cannot be printed, cannot be debased, and cannot be frozen by a sanctions regime. And here is the crucial part. This is not a trade you can time. You cannot wait for confirmation. You cannot wait for Bloomberg to run a headline that says, petrodollar system officially dead. By the time the mainstream media admits what is happening, the repricing will be over. The gold will be $4,000, the oil will be $130, and the currency you're trying to exit will have already lost 30% of its purchasing power. The window is now. The window is this week, this month, before the next escalation, before the next round of sanctions, before the next emergency Fed meeting where they announce another $1 trillion liquidity injection. I want to be very clear about something. I'm not rooting for the collapse of the dollar. I'm not cheering for chaos. I'm simply reading the data. I'm watching the capital flows. And the capital flows are screaming a message that is impossible to ignore. The hegemon is losing grip, not because of military weakness, not because of political dysfunction, but because the rest of the world has figured out how to operate without permission. They have built the railroads, they have laid the track, and now they are running trains on a route that does not go through New York. This conflict with Iran is not the cause. It is the catalyst.